Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
What the world needs now is people who see energy a little bit differently. Because seeing a more sustainable world isn't far in the future. We're building it now. GE, building a world that works.
The government is keen on rolling out 5G services this year. Some reports say that it wants to launch 5G by the upcoming Independence Day. The decks were cleared for its auction in early May. But will the country get the high-speed network anytime soon? A telecom industry body has now told the government that there will be no business case for rollout of 5G networks if operators' concern on private captive networks is not addressed. So will it affect the 5G rollout in the country? Let us find out.
As the government appears determined to roll out 5G services in India, telcos have opposed any move to set aside spectrum for captive private networks at an administered price. They argue that such a move would skew the playing field. On the other side of the fence are private network supporters like the Tatas, ITC and the Broadband India Forum, which counts major global tech players among its members. They have argued that assigning spectrum directly to enterprises is the only way to make Industry 4.0 a reality. Now, the latest blows in this battle over 5G captive private networks have been struck. In a move that could jeopardize India's upcoming 5G spectrum auction, the Cellular Operators Association of India sent a rather blunt letter to the Minister of Communications, Ashwini Vaishnaw, on Wednesday. The letter said there would be no business case for rollout of 5G networks if captive private 5G networks were to be permitted. COAI is the apex body of telecom operators, with Reliance Jio, Bharti Airtel and Vodafone Idea as its key members. COAI has made its position clear, allowing independent entities to set up private captive networks with direct 5G spectrum allotment would severely impact revenues and degrade 5G's business case for telecom operators. It could even force telcos to relook at their 5G spectrum strategy, though most say they are unlikely to pull out from participating in the auction altogether. The COAI letter has said that wherever 5G has been rolled out, there have hardly been any gains in revenue from the retail segment. Instead, revenue and efficiency enhancement can happen only in the enterprise segment, which involves the use cases that an enterprise could instead meet with its captive private network if allowed to. Telcos have said that based on global trends, 40% of the revenues from 5G come from the enterprise segment. They fear that they would end up losing this chunk of revenue. Telcos have also made other arguments against the direct allocation of 5G spectrum through administrative routes to enterprises for private captive networks. They have said that such a move would give a backdoor entry to private companies, do away with the level playing field, and rob the government of valuable revenues. Telcos decided to respond strongly after it seemed possible that the DoT could, in its note for cabinet approval, allow captive private wireless networks to be run by enterprises, as recommended by the Telecom Regulatory Authority of India earlier. If that happens, it would be a complete volte-face.
Government is not going to benefit because it is going to lose out a huge amount of revenue because of lack of auctions, because of lack of discovery of the right price by auction, which legally will be in contravention to the Honorable Supreme Court's direction. But even otherwise, if you see financially, it will be a big loss to the Government of India. So then I don't think they're going to take this action. Third party, the telcos themselves. They've been providing cheap but good reliable services to the consumer for the last 25 years. at very little ARPUs. Now, if this sort of a thing happens, their total business case of rollout of 5G goes for a 6. It is definitely going to create a lot of problems for this Indian telecom industry. And why I'm emphasizing the name Indian telecom industry is very simple to see. Now, the people who are going to get this spectrum administratively allocated to them are not going to spend hundreds and thousands of crores to set up a network within their factory premises or campuses by spending money on capex equipment and opex manpower. They will not do that. Very unlikely. They are going to outsource it to a third party who has the wherewithal and the expertise of doing this. And that third party will be unlicensed, non-participating member in the spectrum auctions. But if he gets 10 or 15 or 16 or 20 of these factory premises to run as an outsource agency on the behalf of people who have got the spectrum allocated, you see, he becomes a telco by himself without having participated, without even being subject to the jurisprudence or to the regulations and policies which are meant for telcos, for the security of the country.
The technology companies have struck back. The Broadband India Forum, or BIF, on Thursday went to bat for direct spectrum allocation for private 5G networks at a nominal administrative fee. Going against the position taken by telcos, BIF argued that the stance that private 5G networks would lead to revenue losses for telcos was a misconception. BIF contends indoor private campus networks do not cut into the legitimate revenue of telcos. According to the industry body, an efficient captive network through private 5G would lead to increased productivity for enterprises. This would help grow business activities and external communications, leading in turn to better revenues for telcos. BIF has argued that most of the revenues accrued by telcos are external and that they remain untouched, and hence government revenues also remain protected. The BIF has also said that there would be no revenue loss to the government on account of direct spectrum allocation for private 5G networks to enterprises, as they shall purchase the spectrum at a price to be fixed by the government and allocated administratively.
First of all, we must understand that private networks is not a public network. It is limited to a local area and has only one potential user in that given area. You cannot have an auction when there is only one user. It makes no sense at all. It's not logical. Hence, the concept of auctions for private networks goes out immediately. It is being misquoted and misrepresented in certain sections that the Honorable Supreme Court of India has actually mandated that only means of assignment of spectrum is through an auction. I would take and draw the reference of all our viewers to Presidential Reference number 1 of the Supreme Court ruling on 2nd February 2012, wherein the Supreme Court opined in its advisory jurisdiction that auction as a method of disposal of natural resources cannot be declared to be a constitutional mandate under Article 14 of the Constitution of India. It further went on to say that though auction may be the best way of maximizing revenues, but revenue maximization may not always be the best way to serve public good. And in this case, what is the public good? The public good is to have digitalization of all the industry and all the different verticals. Hence, it needs to be understood that private networks, with their additional license fee and the spectrum usage charges that they are supposed to pay to the government, actually add another additional revenue stream to the government instead of taking away or reducing the government revenues.
The Business Standard Morning Show had earlier reported that the 5G spectrum auctions are likely to see a muted response from the telcos due to their unmet concerns over pricing. This could be a reason for the slowing down of 5G rollout in India, or at least lead to an uneven spread of 5G services. The tussle over private captive networks will only add to the list of rollout roadblocks. It remains to be seen what impact a muted auction would have on both the government's digital ambitions and revenues.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
It is not just the telecom operators who are staring at depleting revenue. Ludhiana's apparel industry, which churns out most of the country's ready-made garments, are also in a similar situation. 2 months of lockdown in China's Shanghai has brought the industry on its knees. Our next report offers an insight into it.
Shanghai port was never so cramped and calm too. Hundreds of behemoth cargo ships have been anchored offshore for the last 2 months as sea ripples slam against their metal walls only to fade away. That is the only sound one could hear there. But the quiet Shanghai port has been creating a different sort of ripples across most shores of the world. Silence was never so contagious and disturbing too. The effect of lockdown in Shanghai, also known as China's financial powerhouse, has spelt doom for scores of industrial cities across the world. The supply chain is in tatters, and so is the fate of factories, their owners and workers. One such industrial town, over 4,500 kilometers from Shanghai shores and pinned close to the India-Pakistan border, is now a pale shadow of what it used to be a few summers ago. The city, which used to produce about 90% of the country's apparel, has now some of its machinery covered under the same ready-made garments, although unfinished. The accessories like buttons, chains, etc., which went into these apparels used to come from the Shanghai factories. Their journey used to end in the narrow lanes of Ludhiana's bustling Shahpur Road, which housed most of the factories. But the seeming sense of normalcy in this crowded market for fabrics and garments belies the deep distress that the city's textile industry finds itself in. Repeated supply shocks, the latest being the closure of the Shanghai port in China, have all but brought the industry to its knees. Ludhiana, Punjab's 20,000 crore rupees textile hub, accounts for more than 90% of India's apparel production for the domestic market. But for the last 6 years, it has been repeatedly hit by one setback after another. In 2016, demonetization crippled the city's hosiery industry, which mostly comprised micro and small businesses. Then, just as it started finding its feet again, the COVID-19 pandemic piled more misery on it. And the latest supply shock came from the closure of the Shanghai port for the last 2 months. Shanghai handles a fifth of China's cargo, and the country holds a virtual monopoly on the supply of garment accessories such as buttons, chains, embellishments, and so on. Even though the port opened for business last week, industry insiders say that it will take over a month for the supply chain to return to normal. Factory owners say that earlier, basic raw materials would take 15 to 20 days to be shipped and specialized orders would take 60 days. These supply cycles have now extended multifold. So, input costs for manufacturers have also gone up. Vinod Thapar, president of Knitwear Club, an apparel industry association, told Business Standard that several factory owners have been forced to source their accessories locally, but the local products lack competitiveness, both in terms of quality and cost, he said.
जितनी भी accessories हैं चाइना से आती और accessories के बगैर पीस कंप्लीट नहीं हो सकता, तो वैल्यू एडिशन करने में accessories की बहुत जरूरत होती है, तो मोर देन 95% accessories चाइना से आती है, तो इसलिए चाइना अपना accessories बहुत important है हमारी गारमेंट इंडस्ट्री के लिए. Due to lockdown, there is no supply And moreover, if little lax is there, तो वहाँ कंटेनर्स हैं वो उनकी अवेलेबिलिटी नहीं है. अगर हो भी जाए तो आने में 1.5 से 2 महीने लग जाते हैं चाइना टू इंडिया. तो इसलिए काफी ट्रबल में है. सैसिस के अलावा जो हमारी जैकेट्स है जो पॉपुलर है सबसे ज्यादा, उसके जो फैब्रिक्स हैं वो चाइना से हैं. क्वालिटी बहुत अच्छी है, कम्पिटिटिव प्राइस है, बहुत वाजिब रेट से माल आता है. जो इंडियन क्वालिटी है वो उससे मैच नहीं कर सकती है और तो प्राइस भी ज्यादा है. हमारे इंटरनेशनल रिलेशंस अच्छे हो, माल वहां से स्मूथली आना हो जाए. इंडिया में अभी सैसिस की बहुत कमी है.
Many retailers say that their products would not sell even for half the price without the accessories that are mostly imported from China. Thapar and others say that though the Shanghai port reopened on June 1, manufacturers in Ludhiana have already curtailed or delayed their production plans at the risk of not having ready stock by the time peak season arrives in winter. Harinder Thapar, a textile manufacturer and retailer, pointed out another problem: the depreciation of the rupee against the dollar. He said that traders will end up paying more for material. In addition to the cost inflation in basic raw materials, the high price of crude is also severely impacting business, since fabrics like nylon and polyester are petroleum-based products. Sudarshan Jain, President, Knitwear and Apparel Manufacturers Association of Ludhiana, said that the industry expects the prices of winter apparel to increase by 15 to 20% this season. The lockdown in Shanghai has now been lifted. The port is again buzzing with activity and ships are fanning across oceans, heading to far-off cities. The relief for Ludhiana's apparel industry is also on the way.
क्या हाल?
मत पूछ यार,
फिर से स्टॉक्स में फंस गया. तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर.
इसमें बहुत तामझाम है.
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है. 5 पैसा है ऑल इन वन अकाउंट. डाउनलोड 5 पैसा नाउ.
अब तो सबको पता है. Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
China's lockdown and Russia's war on Ukraine has pushed inflation not just beyond the RBI's tolerance level, but that of people too. The central bank is preparing the markets for aggressive rate hikes in months ahead. While this has already pushed bond yields to their highest level since 2019, experts anticipate further hardening of yields on government securities. Our next report takes a dive into where the bonds and equity markets are headed. We also take a look at investment strategies for the next 3 to 5 months.
The Reserve Bank of India front-loaded its rate hikes with a 50 basis point repo increase on Wednesday, as it expects retail inflation to stay above the 6% tolerance level for 3 more quarters. While the markets were expecting a rate hike between 25 and 75 basis points, the Monetary Policy Committee's pitch for a high number indicates that more hikes might be coming. In the fixed income market, the yield on the 10-year government bonds retreated to 7.49% on Wednesday, only to climb back above the 7.5% mark on Thursday. The whipsaw in bond yields reflect the nervousness in the bond market, given a considerable policy tightening expected from the US Federal Reserve and the RBI. According to Vivek Kumar of Quantico Research, 10-year G-Sec yield could crawl to 8% over the next few months, before moderating a bit by the end of FY23 on the back of moderate fiscal consolidation in FY24 and most central banks approaching peak in the respective hiking cycle.
The forecast of uncomfortably high inflation of 6.7% in FY23 is bound to increase the urgency for withdrawal of policy accommodation. And this is happening in a time when the global environment is completely hostile. Most of the key central banks are pretty aggressive in normalizing their own monetary policy rates in their economies. Our own in-house expectation is for a 75 basis point further increase in repo rate, along with the possibility of another 50 basis point increase in the CRR. This, we believe, will push yields up, with the 10-year rate expected to trade closer to 8% before the end of the financial year 2022-23.
Edelweiss Securities, meanwhile, expects the 10-year bond yield to hit a peak of 7.75% as the RBI intends to ensure an orderly conduct of the government's borrowing program. Given this, the brokerage expects the RBI to resort to open market operations to calm the GSEC market. Nonetheless, higher bond yields could shift new investors towards these relatively safe asset classes, while higher interest rates could affect corporate profitability. As a result, equity valuations may be eyeing downgrades in the near term.
So on downside, maximum Sensex can go to 52,000 points. That's about 2 to 4% fall can happen in both Sensex and Nifty if oil fails to correct from the current level. Because both RBI and even US Fed, they have not crossed the midway of rate hike. It's only a beginning of the reversal of monetary cycle. So normally, the market discounts well in advance. So for the market to discount the difficulties coming to the liquidity in terms of rate tightening is not yet started. It will start perhaps after the monetary authority at least fulfill 50 to 60% of the targeted rate hike. So that could happen in the next 2 to 3, 4 months. After that, it all depends upon the oil price. Because my fear is that the Ukraine war may go on for throughout 2022 also. That is also possible because we see a change in the strategy. After 100 days, they have captured only 20% of the total area in Ukraine. So they may opt for marginally incremental encroachment in Ukraine, and therefore the oil might continue to be under pressure. And if oil goes to above $140, then even after 2 months, the market Sensex may not recover and it may settle around 52,000 points. But on the other hand, if oil corrects below 100 by end of the year, you can see anywhere from 62,000 to 65,000 Sensex range, which would be minimum 10 to 12% return from the current level.
Analysts suggest investors stick to low debt businesses, invest in funds having maturity of 2 to 3 years, or dynamic bond funds.
First of all, don't borrow money and invest. If you have a borrowing also, don't make a fresh investment. Try to pay off the borrowing. And within equity corpus, try to have a 5 to 20% cash within the equity. That is my research strategy, I would suggest, because the pain is not yet over. It may continue for 1 or 2 more months. And to some extent, one can bet on the value stock which provide high dividend yield. So last 10 days, we see that some of the stocks which pay dividend yield of 5% or above, they started seeing some bottom, because investors will not offload such stocks even if market falls further, because even instead of putting money in the bank, they can get a better return from the market. So that can be one strategy. The other strategy could be to have a tilt towards Nifty stocks or top 250 stocks, because the DIA support is normally around index stocks, and that would give some comfort.
On Friday, the European Central Bank's interest rate decision and the US jobs data will be some key factors driving the markets. That apart, Brent crude prices, rising COVID-19 cases, and the US inflation data will also be on investor radar.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है. Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Like the income from the markets, taxes are levied on earnings made from sale of residential property too. It is known as capital gains tax. But did you know that in some cases you can save yourself from this tax? Let us know more about it. The profit earned from the sale of a house is taxed as a capital gain. Depending on the holding period, the house may be classified as either a short-term or a long-term capital asset. A tax rate of 20% is levied along with the surcharge and cess as applicable if the property is held for 24 months or more, known as long-term, while the gains are taxed at slab rates if held for a short-term, that is for less than 24 months. Let us say a person wanted to shift his residence due to certain reasons and hence he sold his old house. From the sale proceeds, he decides to purchase another house. In this case, the objective of the seller was not to earn income by the sale of the old house, but to acquire another suitable house. If in this case the seller was liable to pay income tax on capital gains arising from the sale of the old house, then it would impose a hardship on him. Under Section 54 of the Income Tax Act, a seller can avail of tax exemption on the capital gain arising from the transfer of a residential house property. This benefit is available only to individuals and Hindu undivided families or HUFs. Further, the asset transferred should be a long-term capital asset held for at least 24 months. The taxpayer should have purchased the second house within India either 1 year before the date of sale of the old house or 2 years after. If the assessee is constructing a house, then construction expenses incurred within 3 years from the date of sale of the first house would qualify. The exemption under Section 54 will be lower than the amount of capital gain on the sale of residential property or the amount invested in the purchase or construction of a new residential property. Any remaining amount is taxable. The exemption can be claimed only in respect of one residential house property purchased or constructed in India. If more than one house is purchased or constructed, then exemption under Section 54 will be available in respect of one house only. No exemption can be claimed in respect of a house purchased outside India. But with effect from assessment year 2021-22, the Finance Act Section 54 has been amended to extend the benefit of exemption in respect of investment made in two residential house properties, provided the amount of long-term capital gain does not exceed 2 crore rupees. This option can be exercised by the taxpayer only once in his lifetime. The exemption under Section 54 is available in respect of the rollover of capital gains arising on the transfer of a residential house into another residential house. However, to keep a check on misuse of this benefit and to ensure it is available only to long-term buyers, restrictions have been put in place. If a taxpayer purchases or constructs a house and claims exemption under Section 54 and then transfers the new house within a period of 3 years from the date of its acquisition or completion of construction, then the benefit granted under Section 54 will be withdrawn.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Experts have been demanding amendment to Section 54 of the IT Act, saying it has several loopholes which gives people opportunity to indulge in money laundering. That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.